Hi, I'm Miranda Carr, Chief Investment Officer at the Trust Company of Tennessee, and I'm going to be covering some economic and market data from the fourth quarter of 2024. Looking at how markets behaved in the fourth quarter, we did see a lot of volatility in both interest rates and equity markets. Of course, we had the election along with a slew of policy proposals, and at times those headlines caused investor optimism and at times a bit of market panic. U.S. equity markets did end the quarter up a bit, while we saw a broad-based sell-off in international markets as investors interpreted the new administration's policies would have a negative impact on developed and emerging international markets. The dollar also strengthened. Interest rates moved up on actual inflation data, which inched a bit higher, but also on expected inflation. So the two main policy ideas of the Trump administration regarding immigration and tariffs could both be inflationary. We still have a very tight labor market, and so if you shrink the supply of labor, of course, the cost of labor goes up, pushing up prices across the economy. And it should be pretty self-explanatory that when you put a tariff on a good, the price of that good obviously goes up. So core bonds, long bonds, most bonds down during the quarter on those rising rates and fears of inflation taking back up. Rising interest rates also had a big negative impact on the REIT space, and these are publicly listed real estate. That asset class is very sensitive to interest rates, especially in the short term, but you can see that the real assets and even commodities were not a good hedge against these rising fears of inflation because it's not inflation driven by higher commodity prices, it's inflation expected to be higher in the labor-intensive service sectors. But overall, 2024 was a great year for equities. The S&P 500, which is composed of large U.S. companies, was propelled ahead by continued excitement over AI, and the Mag 7 in particular had huge gains for the year. Core bonds also had a positive year, even though interest rates moved up. So the coupon or interest income, part of that return, helped offset losses in the price of the bonds. So a really nice year across asset classes. It was a nice year for the economy as well. The economy grew at a faster pace than expected, driven by consumer spending. In fact, full year 2024 GDP came in at 2.8%, so above that long-term trend of 2%. But the higher growth rate also came with higher than expected inflation, which has ticked up a bit. It's now at 2.9%, so still well above the Fed's target of 2%. And then there are also concerns that some of those policy proposals, like tariffs and immigration policy, could put even more upward pressure on price levels. So interest rates moved up on this possibility, even though the Fed cut the Fed funds rate by 0.5 percentage point during the quarter. And then another theme that continues to play out is this high concentration of the top 7 or top 10 names in the S&P 500. At year end, the top 10 companies made up about 39% of the index, which is just much higher than levels we've seen historically. As I mentioned, U.S. large cap stocks had another very positive year. Technology stocks, communication sector, and the consumer discretionary sector, which includes names like Tesla and Amazon, had a strong fourth quarter. This chart on the bottom shows the difference in U.S. equity markets versus their international counterparts. And you can see across the board, international markets were down, while in the U.S., value was down, but growth was up and large companies outperformed small. We've discussed this before about how these top 7 stocks in the S&P 500, which have come to be known as the Magnificent 7 or Mag 7, have had a huge run and a huge impact on the performance of the overall index. If you look at the last 2 years, we see more muted returns for the S&P 493, so the index of 500 companies excluding the Mag 7. And you can see that those top names have accounted for more than half of the return of the index. So this has been great for investors who have been highly concentrated in those names, but it does increase the risk of the index substantially. So just for context, if the top 10 names are down 13%, which is feasible, these are very volatile names, but the other 490 names are up 7%, the index will be flat for the year, so no change. So the impact of the performance of these names due to their high allocation in the index has driven the very positive performance of the S&P 500 over the last 2 years. But it could also very well drive it down if there is negative news or a company misses earnings. So we aren't recommending avoiding those names altogether. On the right side of this page, you can see the earnings growth of those Mag 7 names has been very positive. and it has outpaced the rest of the names in the index. The same goes for profit margins. So these are very profitable companies that are growing. They have growing free cash flow, and the fundamentals are still positive for these companies. The problem is just that they're expensive, and the price has grown faster than the earnings. So when you get to really high multiples of price to earnings, historically, this has meant that returns in the future will be lower because the earnings need to catch up at some point. So we think it's best to have exposure to these great dynamic American companies, but to also hold other things that haven't gotten quite as expensive, where there is some room for some upside surprise. Now, there are a lot of ways to add diversification to a portfolio, and one thing that we like right now is the S&P 500 Equal Weight Index. So this is a different index than the regular S&P 500, but it holds the same 500 companies. The regular S&P 500 is a market cap weighted index, which means that the bigger the market cap or the bigger the company, the bigger the weight in the index. And then the equal weight, again, has those same exact companies, but as the name suggests, equal weights them. So this gives us exposure to all those great large US companies like Pepsi and Walmart and Pfizer and Nvidia and Apple and Google, but it limits the concentration risk because you don't have those top 7 names dominating the index. And when compared to the regular cap-weighted S&P 500 index, it has had periods of outperformance as well as periods of underperformance. Most recently, we've been in a period of underperformance, as it has been better to have had all those large overweights to those top names. But we think this could be pretty interesting when combined with the regular S&P 500 to get that US exposure without increasing the concentration risk of the overall portfolio. Another way to get diversification in a portfolio is to look outside of the US, and there are some really great companies out there. In fact, while 2024 was a standout year for Nvidia and Apple, most years the best performing single stocks are actually not US companies. And even last year, if we look at the top 10 or so best performing stocks in ACWI, which is the All Country World Index, a couple of those companies are outside of the US. So they're in China or Taiwan, and Europe has some great international companies as well. So from a pure fundamental standpoint, we are now at the most attractive time to own international stocks in decades. The valuation relative to the US is at a historic low, and while we are seeing historic high concentration in the US, it makes sense to look elsewhere for part of the portfolio and get exposure to some really great multinational companies at a great price. And while these numbers for the broad index look attractive on their own, we think that active managers who are picking stocks, so doing due diligence on companies, they're able to avoid regions that may be excessively risky, can add even more value. So you don't even have to hold the entire index here. We use managers who are picking those best top companies in international markets. They're plugged into what's going on the ground in each country, in each sector, and they've done a really nice job navigating the international landscape over the last few years. And of course, another way to diversify your portfolio away from that concentration risk in the S&P 500 is to have a bit of fixed income. And the fixed income market is really not just one market. There are lots of ways to build exposure to bonds in the portfolio. But broadly, if we look at the US Ag, we can see that it was up a bit in 2024, even with the move up in rates because of that coupon wall. So rates are now at a high enough starting point that the income payment provides protection from an increase in yields. So returns to bonds are less exposed, and this is referred to as the coupon wall. So we're at a point where there's a lot of asymmetry in the return outcomes for a 1% move in interest rates. Of course, those long duration bonds are more sensitive to rate moves, but most sectors of the bond market are now yielding rates that are high enough to offset modest increase in interest rates. And if the economy were to slow down or we had a risk-off event, you can see we would have very positive returns if rates move down 1%. So the math here just works out that the US Ag, for example, would be up 11% if interest rates move down 1%. So this is one reason we would advocate investing in bonds rather than cash, because cash gives you no downside protection. The moment those yields move lower, the cash rate or money market rate follows it down immediately. And the price of your cash is the same, right? The price isn't going up. So yields are pretty similar right now for bonds and money market, but there's a tremendous amount of reinvestment risk here, because once yields move down, they're lower, and it's too late to invest and get the same yield. Cash rates have already moved down. The price of the bond has already gone up. So it's a good time to look at how much cash you have in your investment accounts and consider whether fixed income makes more sense at this point. I think it's always a good idea to revisit your allocation each year and make sure that it aligns with your financial goals and your risk tolerance. We have a practice of rebalancing accounts back to their target weight once a year. And this is a really important practice for risk management. This chart shows a portfolio that started at 60% equities and 40% bonds in 2019 and how it has drifted over the last 5 years. So this assumes no trading. You buy your allocation in 2019 and then you do nothing. But what happens is that over time, riskier assets have higher returns than fixed income, and so they grow to be a bigger share of the portfolio over time. So if a 60-40 allocation with its risk and return profile is the most appropriate for your financial plan, and you don't rebalance, by the end of 2024, your portfolio is now about 75% in equity and 25% in fixed income. And the growth part of that equity portfolio is 37% rather than 25%. So this portfolio has substantially more risk than the portfolio you started with. A big move in those Mag 7 names will be much more painful than it would have been at allocations set in 2019 because they're a bigger part of the portfolio. And most of the time, this is unintentional. This is different than making an active decision to move from 60-40 and get more aggressive in 2024, right? So rebalancing back to target once a year allows for the portfolio to drift while realigning the risk back to target periodically. I'll wrap up with a look at real assets. Gold had one of its best years ever in 2024, up 25% for the year, while base metals and agriculture were down and energy had more muted returns. So most commodity prices are very dependent on economic growth. Commodity prices for things like oil, gas, copper, aluminum, pork, cocoa, they're driven by supply and demand, and really mostly demand. Occasionally, we see supply shocks, like we did when Russia invaded Ukraine and sparked fears of shortages in commodities. But typically, the demand for energy or building materials is what drives commodity prices up. And more specifically, an acute increase in demand. So when global economy is strong and China and other parts of Asia are building, there is a demand for these commodities that starts to outstrip current supply. And then more supply comes online and prices revert back down to long-run averages. So when we think about inflation and commodities being a hedge, we really have to think about what it means in terms of where the inflation is coming from. So if we have unexpected inflation due to an exogenous shock in the supply of commodities, which often happens with oil, usually for geopolitical reasons, yes, that inflation is directly coming from the price of oil being high, and in that case, it's great to own oil. If, however, the inflation is coming from labor shortages and impacting the price of services like restaurant meals or construction or childcare, we usually don't see higher commodity prices in those scenarios. So when we think about real assets hedging against inflation, we do try to be thoughtful about what the root cause of inflation may be and how to hedge against that, because over long periods of time, commodity prices tend to revert to their long-run averages, and the long-term return for commodities is actually close to zero. So for REITs, which are publicly listed real estate, this is an example of an asset class that could see higher prices due to shortages in housing or higher demand for data centers or premium office space. REITs are a unique asset class because they reflect the fundamentals of supply and demand in the various real estate sectors, but they also tend to be very long duration assets and inherently sensitive to changes in interest rates. So we see both components here with the growth on one side and the interest rate sensitivity on the other. So they are a nice way to add diversification to a portfolio because they don't move exactly in step with equities or bonds. The fourth quarter was a tough quarter for REITs, with nearly all sectors down on a big increase in rates, but they were overall positive for 2024, and the asset class still has a favorable outlook going forward. So I hope this has been helpful to make sense of what's going on in the economy and the markets. If you have any questions, please reach out to your relationship manager. We would love to hear from you.